Disclaimer.
You saw what happened this week. Silver didn't just climb. It exploded through $92, then dropped 15% in a single session so violently that traders who've been in this game for decades said they'd never seen moves like this. And here's the part that should make you pause. That brutal whipsaw wasn't random. It was engineered. Earlier this week, while you were watching silver charge toward $93, the CME group made a change that barely hit the news. They switched silver futures margins from fixed dollars to percentage-based calculations. First time ever. Sounds technical, right? Boring regulatory stuff. But let me translate what that actually meant. If you were holding one silver contract that day, you woke up to a margin call demanding $7,500 more cash. Immediately. That's a 30% increase in the collateral you needed just to keep your position open. Not because you were losing money, not because you made a bad trade, because the exchange changed the rules overnight while you were sleeping. Let that sink in for a second. You're playing a game where the house can change the rules mid-hand and force you to either put up more chips or fold your winning position. That's not a free market. That's a trap with a timing mechanism built right into it. Now ask yourself this. When was the last time the CME changed margin requirements right as silver was spiking toward historic levels? I'll give you two answers. 1980 and 2011. Want to know what happened next in both those years? Silver crashed more than 50% within months. In 1980, they called it Silver Rule 7, and it sent prices from 50 down to 10, a 57% wipeout. In 2011, they raised margins 5 times in 9 days right at the $48 peak, triggering a 44% collapse down to $14. The playbook is identical. Let silver run. Wait until retail traders are fully committed with maximum leverage, then change the margin requirements to force liquidation. It's the most effective way to drain capital from small traders and transfer it to the institutions who can afford to post unlimited collateral. Think about what just happened to thousands of traders around the world. You bought silver at $75. You're up huge. You're watching it climb to $90, maybe $95. This is the trade of your life. Then at 3 a.m., you get an email from your broker. Margin call. $7,500 by market open, or we liquidate your position. You don't have that cash sitting in your account. It's already in the market. So what do? You sell. Not because the story changed, not because you stopped believing in silver, because you literally have no choice. The exchange just made it mathematically impossible for you to stay in your winning trade. Multiply that by every leveraged trader holding futures contracts. Everyone getting the same call at the same time. Everyone forced to dump into a market that's suddenly flooded with desperate sellers. That's how you get 15% intraday swings in a commodity that is supposed to be a store of value. That's how you get violence that has nothing to do with supply and demand fundamentals. And here's what makes this margin change particularly devastating. It's not a fixed increase anymore. The new system is percentage-based, which means it scales automatically with price. So if silver climbs from $92 to $100, your margin requirement increases proportionally. Then if it hits $106, you need even more capital. The higher the price goes, the more cash you need just to maintain the same position. It's a self-reinforcing liquidation machine built right into the exchange rules. But here's where it gets wild. Wall Street analysts are publishing targets of $100, $135, even $300 based on inflation-adjusted calculations from 1980. Bank of America put out research forecasting silver could hit those levels based on historical precedent and current supply constraints. The financial media is treating $100 silver like it's the finish line. Everyone's asking when we'll get there, and almost nobody's asking the question that actually matters. What happens after we hit $106? Because $106 isn't just another price level. It's a Fibonacci extension that every technical trader on the planet is watching. It's the psychological trigger that's going to separate the smart money from the people who are about to get destroyed. It's the line in the sand where human emotion overrides every bit of analysis and discipline. Let me explain how this works. Everyone who sold silver at $85, thinking they were taking smart profits, watches it grind to $95. They pat themselves on the back for being disciplined. They tell themselves they'll buy back in on the pullback. But there is no pullback. Silver keeps grinding higher, $98, $101, $104. And with every dollar it climbs, the psychological pressure builds. You sold at 85, you're watching from the sidelines. You could have made another $20 per ounce if you just held. That's real money you left on the table. The regret starts eating at you. You tell yourself you'll wait for a better entry, but the better entry never comes. And then something breaks inside your head. The fear of missing out completely overwhelms every logical thought. You buy back in. Not at $85 where you sold. Not even at $95 where you should have admitted you were wrong. You buy at $105, maybe $106, right at the Fibonacci level everyone's watching. At the worst possible moment. Right as the move is exhausted. right as everyone who's been long since $75 starts quietly distributing into that desperate buying. This is the blow-off top pattern that repeats in every parabolic market. The late buyers provide the liquidity that smart money needs to exit without crashing prices immediately. You've seen this pattern before, even if you didn't recognize it. Tech stocks in 2000, housing in 2007, Bitcoin at $20,000 in 2017. The setup is always identical, a real fundamental story that makes sense, a price move that validates the story, media attention that brings in new buyers, then a final parabolic spike that sucks in the last skeptics right before everything collapses. The people who buy at the top aren't stupid. They're responding to real information, but they're responding to it at exactly the wrong time, after the move is already exhausted. But the current silver situation has something different, something that makes this potentially more dangerous than those previous bubbles. We're dealing with two completely separate markets operating under the same ticker symbol, and they're starting to disconnect in ways we've never seen before. Paper silver, futures contracts, ETFs, derivatives. That's where margin requirements matter. That's where leverage dominates. That's where the CME's new percentage-based system just made the game significantly more violent. This is the market that sets the spot price you see quoted on every financial website, the number that scrolls across CNBC. Then there's physical silver, the actual metal, coins, bars, the stuff you hold in your hand. And if you've tried to buy physical silver recently, you know exactly what I'm talking about. You know there's something deeply wrong with the quoted spot price. Dealers are charging $12 or more over spot price for silver eagles. Some are charging $15. When paper silver hit $89, you couldn't buy a physical silver eagle for under $101 if you could even find one in stock. Try calling your local coin shop right now. Ask them what they're charging for silver eagles. Then ask them how long the wait time is if you actually want to take delivery. The answers will shock you. The premiums are screaming that there's a real shortage in the physical market. This isn't speculation. This is dealers telling you through their pricing that they can't get enough metal to meet demand. COMEX inventories are down roughly 70% from recent peaks, according to exchange data. The registered silver available for delivery has been draining month after month. China, which controls an estimated 60 to 70% of global refined silver production, just started requiring export licenses as of January 1st this year. That means they can restrict how much silver leaves the country at any time. Solar manufacturers are consuming silver faster than ever because every panel needs it. EV producers need it for electronics. AI data centers need it for servers and infrastructure. There's no substitute for silver's unique electrical and thermal conductivity properties in these applications. These fundamentals are real. The supply crisis is real. The demand explosion is real. Industry experts and mining analysts are confirming these trends. This isn't hype. It's basic supply and demand economics. But none of that saves the leveraged trader getting margin called at 3 a.m. who needs to raise cash in 6 hours or watch his broker liquidate everything at whatever price the market gives. That trader doesn't care about solar panels or Chinese export restrictions or long-term demand trends. He cares about one thing only, not blowing up his account, not losing his house because he couldn't meet a margin call. This is the violent disconnect happening right now. Physical buyers can be patient. They're not leveraged. They don't get margin calls. They can hold through 15% daily corrections without breaking a sweat. But the paper market still sets the spot price you see quoted everywhere. And that market just got hit with the most aggressive margin system in history, right? As prices are spiking toward triple digits. We already saw this play out in miniature. Tariff threats against Canada and Mexico sent silver spiking to $92. Everyone thought it was the breakout. Then those threats got walked back and silver dropped 9% in one day. One day. That wasn't a fundamental change in the silver story. That was over-leveraged positions getting flushed on a headline reversal, violence that had nothing to do with actual supply and demand, just forced selling from traders who couldn't handle the volatility. Now imagine that same dynamic at 106, when the percentage-based margins are demanding even more collateral than they are right now. When the early sellers who got out at $85 finally crack and chase the move back in, when the traders who have been long since $75 or $80 start taking profits into that desperate late-stage buying, when the margin pressure peaks and the forced liquidations start cascading, what comes next? That's the question nobody's asking while they are hypnotized watching the climb toward 100. Everyone wants to know if silver will hit triple digits. Almost nobody's asking what happens the day after it does. Because if there's one lesson that history teaches us over and over in every single parabolic market that has ever existed, it's this. The most dangerous moment in any parabolic move isn't when prices are rising. It's the second they stop. Let me show you exactly how this plays out, because this isn't theory. This is documented history that keeps repeating, and the people who ignore it are the ones who lose everything. 1980, The Hunt brothers were accumulating silver. The price was climbing from $6 to $10 to $20. Everyone knew something big was happening. By January, silver touched $50 an ounce. Adjusted for inflation, that's over $180 today. The media was calling it the trade of the century. Retail investors were pouring in. This was it, the big one. Then the CME implemented Silver Rule 7 on a Sunday. When markets were closed and nobody could react, they changed margin requirements so drastically that traders woke up Monday morning to margin calls they couldn't possibly meet. The requirement went from allowing you to control silver with relatively small capital to demanding you put up massive amounts of cash just to stay in your position. What happened next? Silver collapsed 57% from $50 to $10 in a matter of months. Not because the fundamental story changed, not because industrial demand disappeared, because the exchange made it impossible for leverage traders to stay in their positions. They were forced to sell, all of them, at the same time, into a market with no buyers. Fast forward to 2011. Silver had been climbing steadily from $15 to $30. By April, it hit $48 an ounce. The story was different this time. It wasn't about the Hunt brothers. It was about quantitative easing, currency debasement, fears of inflation. The fundamental case was solid. Dealers couldn't keep physical silver in stock. Then the CME raised margins, not once, 5 times, in 9 days. Each increase forced more traders out. Each liquidation pushed prices lower. Each drop triggered more margin calls. The cascade was unstoppable. Silver crashed 44% to $14 within weeks. By 2015, it had lost 70% from its peak. Now look at what just happened this week. The CME switched to a percentage-based margin system that requires roughly 9% collateral on silver futures. That might not sound like much until you understand what it means in practice. As silver climbs, your margin requirement climbs automatically with it. There's no cap, there's no limit. The higher the price goes, the more cash you need. This is the most aggressive margin system they've ever implemented. More aggressive than 1980, more aggressive than 2011, because those were fixed increases. The system scales infinitely. At $92, you need X dollars. At $100, you need more. At $106, you need even more. And if silver somehow climbs to $135, like Bank of America is forecasting, the margin requirement would be astronomical. Think about what that does to trader psychology. You're watching silver climb, you're making money. But every dollar it goes up, you need to post more capital just to stay in the trade. At some point, you run out of capital. You can't post anymore. And when that moment hits, you're forced to sell regardless of how bullish you are on silver's long-term prospects. This is the mechanism that's going to create the violence after $106, not fundamentals, not supply and demand. Forced liquidations from traders who literally have no other choice. But here's what makes the current situation even more dangerous than 1980 or 2011. Back then, the paper market and the physical market moved together. Premiums were reasonable. If you wanted to buy physical silver, you could get it pretty close to spot price. The markets were connected. That connection is completely broken down. Right now, according to data from industry analysts, we're facing a supply deficit of roughly 200 million ounces annually. That's the gap between how much silver is being mined and refined versus how much is being consumed by industry. Every year, we're burning through 200 million more ounces than we're producing. That deficit has to come from somewhere. It's coming from above-ground inventories, from recycling, from COMEX warehouses. China controls an estimated 60 to 70% of global refined silver production. Let me repeat that. One country controls roughly 2/3 of the world's silver refining capacity. And as of January 1st, they started requiring export licenses. That means they can turn off the tap to international markets whenever they want, for whatever reason serves their strategic interests. Solar panel production is exploding. Every panel requires silver paste for the photovoltaic cells. There's no substitute that works as well. As the world builds out renewable energy, silver consumption from solar alone is projected to absorb massive amounts of annual production. EV manufacturers need silver for electronics and battery management systems. AI data centers need silver for servers, for cooling systems, for the physical infrastructure of the digital economy. The demand side is accelerating. The supply side is constrained. This is the fundamental case that has analysts publishing price targets of $100, $135, some even talking about $309 if we see inflation-adjusted moves similar to 1980. But here's the brutal truth that nobody wants to say out loud. A 60% correction from $106 puts silver at $42. That's not a wild prediction. That's just math based on historical precedent. In 1980, silver dropped 57%. In 2011, it dropped 44% initially and 70% by 2015. A 60% drop is right in the middle of those historical ranges. Think about what that means if you're chasing the move at 105. You buy thinking you're getting in before the big breakout to 135 chasseurs. Then, instead of going up, silver collapses to $40. You just lost 60% of your capital. That's not a correction you can wait out if you're leveraged. That's account destruction. And here's the part that should terrify anyone who's planning to hold through the 106th level without taking any profits. The move down can be faster and more violent than the move up. In 1980, it took months for silver to climb from $10 to $50. It took weeks to crash back down. In 2011, the climb took years. The crash took weeks. Why? Because fear moves faster than greed. When prices are rising, people scale in slowly. They're cautious. They take partial positions. They wait for pullbacks. But when prices are crashing and you're sitting on a losing position with margin calls hitting your account, you don't wait. You don't average down. You panic and hit the sell button at market price. That's when you get days where silver drops 15% in a single session. That's when you get limit down moves where there are no buyers at any price. That is when the market completely seizes up, and you can't even exit your position because there's no liquidity. The physical market won't save you either. You might think you'll just take delivery of physical silver and ride out the storm. But remember those premiums we talked about? When spot silver was at $89, physical eagles were selling for $100. That's a $12 premium. When silver crashes to $42, do you think dealers are going to be buying back those eagles at $42 plus a $12 premium? No. They're going to be offering you $30 if you're lucky, because they're sitting on inventory they bought at $89 and they need to protect their own capital. The physical market always disconnects from spot price during violent moves. Always. It lags on the way up and it lags on the way down. You can't arbitrage it. You can't use it as a hedge against paper positions. The two markets operate on completely different time frames and mechanics. So you've got this setup where the fundamentals are genuinely bullish. Supply deficit, Chinese export controls, industrial demand exploding, physical premiums at historic highs. All of that is real. But the paper market, which still controls the spot price everyone watches, just got rigged with a margin system designed to flush out leverage traders at precisely the moment when prices are most extended. This is the trap. The fundamentals attract you in. The price action validates the story. The media attention creates FOMO. The margin system ensures maximum pain. And the timing mechanism is set to trigger right around $107 when psychology overwhelms discipline. Have you noticed how every piece of analysis you're reading focuses on why silver could go higher? All the forecasts talking about $135, $200, $309. Nobody's publishing research about what happens if it doesn't. Nobody's modeling the downside scenario. Because downside doesn't get clicks, downside doesn't sell newsletters. Fear of missing out is a more powerful emotion than fear of losing money, at least until you've actually lost the money. But the historical data doesn't lie. Every single time silver has made a parabolic move in modern history, it has crashed 50% or more from the peak. Every single time margin requirements were raised during the spike, it marked the top within weeks. Every single time retail traders chased the move late, they got destroyed. The only question that matters now is whether you're going to be on the right side of this pattern or the wrong side. Because the pattern is going to repeat. It always does. The mechanism is already in place. The margin system is already changed. The psychology is already building. The only variable left is timing. And if history is any guide, then that timing trigger is sitting right around $106. Now, let me show you the math that nobody wants to talk about. Because once you see these numbers, you can't unsee them. And you'll understand exactly why $106 isn't the beginning of something bigger. It's the end. The $106 level is a Fibonacci extension. For those who don't follow technical analysis, Fibonacci levels are mathematical ratios derived from a sequence where each number is the sum of the two preceding ones. Traders use these levels to identify potential support and resistance zones. The 161.8% extension from silver's recent base projects to roughly $106. Here's why that matters. Fibonacci levels become self-fulfilling prophecies in markets because everyone is watching them. When enough traders believe a level is significant, their collective behavior around that level makes it significant. It's like a magnet that attracts price action. So picture what happens as silver approaches $106. Every technical trader on the planet has alerts set. Every algorithm programmed to trade silver has $106 marked as a critical level. Every newsletter, every YouTube channel, every trading chat room is talking about it. The psychological weight of that number is massive. And that's when the early sellers crack. The ones who got out at $85, the ones who sold at $90 thinking they were smart. They've been watching silver climb without them. $95, $98, $101. The regret has been building. The FOMO has been intensifying. And when silver touches $105, something in their brain snaps. They buy. not with a small position to test the waters. They go all in because they've already missed so much of the move. This is their last chance. They convince themselves that 106 is just a pause before the run to 135 or to $200. They're not buying based on analysis. They're buying based on emotion, based on the pain of watching everyone else make money while they sat on the sidelines. This late-stage emotional buying provides the liquidity that smart money needs. The traders who bought at $75 have been sitting on huge gains. They've been waiting for the perfect moment to distribute their positions without crashing the market. And here it comes. A wave of desperate buyers rushing in at $105, $106, providing the bid that allows smart money to quietly sell everything they own. This is how every parabolic top forms. The last buyers in are the first casualties out. They provide the exit for everyone who was early. And then when the selling pressure overwhelms the buying, when there are no more late buyers left to chase the move, the collapse begins. Now let's talk about what that collapse could look like based on historical precedent. I'm not predicting this will happen. I'm showing you what the math suggests is possible based on how silver has behaved in every previous parabolic cycle. A 50% correction from $106 puts silver at $53. A 60% correction puts it at $42. A 70% correction puts it at $32. Look at those numbers carefully. The 42 quarters to 53 zone is significant because that's roughly where silver broke out from before this entire rally started. Markets have a tendency to retrace back to breakout levels after parabolic moves. It's like a rubber band that got stretched too far, snapping back to where it started. The 32 level represents the 70% correction that silver experienced from 2011 to 2015. It took 4 years for that full decline to play out, but the initial crash happened in weeks. From $40 to $14 was the first leg. Then it ground lower over time as the reality of oversupply and reduced investment demand set in. Which scenario plays out this time? Nobody knows. Anyone who tells you they know is lying. But here's what we can observe from the current setup. The percentage-based margin system creates automatic selling pressure as prices rise. The higher silver climbs above $106, the more capital traders need to post. At some price, even the most bullish traders run out of available capital. That's when forced liquidations begin. Physical supply constraints are real. The 200 million ounce deficit is real. Chinese export restrictions are real. Industrial demand is real. These factors could support prices and prevent a full 70% collapse like we saw from 2011 to 2015. Maybe silver only corrects 40% to the mid-Fibonaccis before finding support from physical buyers. Or maybe the paper market completely disconnects. Maybe we see a scenario where paper silver crashes to $40 while physical premiums explode even higher than they are now. Maybe you can sell paper silver at $40, but you can't buy a physical eagle for less than $65. That kind of extreme dislocation is possible when fear dominates and dealers refuse to sell at spot prices. The point is, the range of possible outcomes is massive, and all of them involve significant downside risk from current levels if you're buying near the top. Let's talk about timing. Based on current momentum and the way silver is trading, the $100 to $106 zone could be tested within the next 30 to 60 days. That's not a prediction. That's an observation of how fast this move has been happening. Silver went from $75 to $92 in a matter of weeks. If that pace continues, triple digits aren't far away. What happens after silver hits $106 depends entirely on how it behaves at that level. Does it consolidate? Does it pause and build a base for 3 to 6 months like gold did in 2024 before pushing to new highs? Or does it form a topping pattern with lower highs and increased volatility signaling distribution is happening? Gold's 2024 pattern is instructive here. Gold consolidated for months after hitting all-time highs. It built a base. It shook out weak hands. Then it broke out again to even higher levels. That pattern is possible for silver if the physical supply constraints are severe enough and industrial demand keeps accelerating. But silver is not gold. Silver is more volatile. Silver has less liquidity. Silver is more vulnerable to margin-induced selling because more of the market is leveraged traders rather than long-term holders. The 2011 pattern where silver crashed immediately from its peak is just as likely, maybe more likely, than the gold consolidation scenario. So what does this mean for someone holding silver right now or thinking about buying? You need to make your own decisions based on your own risk tolerance and time horizon. But here are the scenarios you should be thinking about. If you bought silver at $75 or lower, you're sitting on substantial gains. The question is whether you're willing to ride those gains back down if silver corrects 50% to 60% from 106. Some traders will take partial profits into strength around $100 to 106, maybe 20% to 40% of their position, to lock in gains while keeping exposure if the move continues. Others will hold everything and risk giving back all their profits if a crash happens. If you're thinking about buying silver for the first time at $90 or $95 or $100, you need to understand you're buying at a moment of maximum risk. You could catch the final spike to $135 if the breakout scenario plays out, or you could be buying right before a 60% collapse that takes silver back to 42s. The risk reward at current prices is completely different than it was at 75 or 65s. If you're holding physical silver you bought years ago at $20 or $25, you're in a different position entirely. You're not leveraged. You don't get margin calls. You can hold through any volatility, but you should still be aware that prices could correct dramatically from current levels, and the premiums you're seeing now might evaporate if paper silver crashes and dealers panic. The key insight is this: the $106 target that everyone is focused on isn't a destination. It's a trigger. It's the psychological level where emotion overwhelms analysis, where late buyers rush in, providing exit liquidity for early buyers, where the setup for the next major move, whether up or down, gets established. History shows us that major corrections always follow parabolic moves. Always. The only variables are timing and magnitude. Silver could consolidate at $106 and push higher after building a base, or it could crash immediately like it did in 1980 and 2011. Both outcomes are possible. Both have historical precedent. What determines which path we take? Watch the behavior after 106. If silver hits that level and immediately reverses with high volume and increased volatility, that's distribution. That's smart money selling to late buyers. That's the setup for a crash. If silver hits $106 and consolidates sideways for weeks or months, grinding between $100 and $110 while shaking out weak hands, that's base building. That's the setup for a potential breakout to $135 or higher. The market will tell you which scenario is playing out, but you have to be watching. And you have to be honest with yourself about what you are seeing rather than what you want to see. Because the hardest thing in trading isn't identifying the pattern. It's acting on it when it conflicts with your emotional desire for the asset to keep going up. The trader who bought at $75 and sells at $105 will feel like an idiot if silver runs to $135. But they'll feel like a genius if silver crashes to 42. Nobody rings a bell at the top. Nobody tells you when to sell. You have to make that decision based on your own analysis of risk and reward. But what I can tell you is this: every single person who bought silver at the top in 1980 thought they were getting in before the big move. Every single person who chased silver at $48 in 2011 thought the fundamentals justified higher prices. They were buying based on real supply deficits and real demand growth. The story made sense, but the timing was catastrophically wrong. The story makes sense now too. Physical deficits, Chinese export restrictions, industrial demand. These are real factors that could drive silver much higher over time. But that doesn't mean silver CA ain't crash 60% first before eventually recovering and going even higher years from now. The question you need to ask yourself is simple. Are you positioned for what you hope will happen? Or are you positioned for what could happen based on historical precedent? Because $106 is coming. Whether it comes next week or next month, it's coming. And when it does, the decisions you make in that moment will determine whether you are on the right side of history or the wrong side. The pattern is set. The mechanism is in place. The psychology is building. The only question left is whether you'll recognize the top when it forms, or whether you will be one of the late buyers providing exit liquidity for everyone who got in early. The choice is yours, but make it with your eyes open. Because in markets, ignorance isn't bliss, it's bankruptcy.